Imagine being down on your luck and suddenly hearing about a once-in-a-lifetime investment opportunity. A company's stock is currently priced at 10 cents a share and is guaranteed to skyrocket, but you have to get in now. You decide to empty your savings and invest $1,000, which buys you 10,000 shares. If the price of the stock jumps to a mere $1, you'll suddenly be looking at a 900% return, which will turn your hard-earned money into $10,000. Yet, a few days later, the stock price begins to plummet, and before you know it, all your money is gone, and the stock price will likely never go past 10 cents a share again. You're left reeling as your dream of hitting a financial home run quickly turns into a nightmare with no way out. Alluring as a gold mine, but risky as a minefield, this scenario plays out each and every day to thousands of individuals. They fall prey to the all-too-common pump-and-dump schemes that often accompany penny stocks. In today's deconstruction, we're going to look at why penny stocks are a scammer's dream, the dark side of pump-and-dump schemes, and how they psychologically prey on the most vulnerable, whether penny stocks pump-and-dump schemes can be stopped, and why most times the investment opportunity of a lifetime really is too good to be true. When it comes to penny stocks, red flags are often abound and hiding in plain sight. But what are penny stocks, you may ask? In the US, the term penny stocks typically refers to stocks trading below $5 per share. These stocks are often traded over the counter or on less regulated platforms. Over the counter, commonly known as OTC markets, are stock exchanges where stocks that aren't listed on major exchanges such as the New York Stock Exchange can be traded. More than 12,000 stocks trade over the counter. There are indeed many legitimate companies found on OTC markets, as oftentimes they can be a good avenue for companies to raise capital without the complexities and high costs of being listed on one of the major exchanges. These companies can range from promising startups to ailing businesses on their last financial legs. However, a lack of liquidity, susceptibility to manipulation, and scant regulatory oversight make penny stocks a risky endeavor. For many, the allure of penny stocks is not just the potential for dramatic gains, but the excitement of the chase itself. Every investor becomes a detective, scrutinizing balance sheets, news releases, and market chatter for clues. Unlike blue chip stocks, which are stocks issued by well-known and financially sound companies and where large financial institutions often hold sway, penny stocks allow the small investor to play a more significant role. Each purchase is a bet, each sale a calculated risk. What makes penny stocks the stuff of legends is their capacity for unbelievable gains. Imagine investing just a few $100s and waking up to find your portfolio has doubled or tripled overnight. The accessibility of these stocks attracts a new breed of investors, high-stakes gamblers, and even risk-taking fraudsters. It's the stocks market's version of the Wild West, where your pocket change could theoretically turn into a fortune. Scams are rampant in penny stocks, as counterfeiters were in the old gold rush towns. And the most prominent scam of all, the pump and dump, often leaves devastating consequences, as most people who fall prey to these schemes are retail investors. Now, let's take a look at the anatomy of a penny stocks pump and dump scam. At its core, a pump and dump scam is a manipulative practice that inflates the price of a stock through misleading or downright false information. Here's how it typically works. Step 1 is accumulation. The perpetrators of the scheme accumulate a significant quantity of the penny stock. These are often shares in small companies with limited trading volume, making them easy to manipulate. Step 2, pumping. Through social media, online forums, and sometimes even press releases, the orchestrators spread overly optimistic or entirely false information about the company. The goal is to create buzz and drive up demand, pumping the stock price higher and higher. Once the price has reached a satisfactory peak, the schemers dump their shares into the market, cashing in on the artificially inflated prices. This then leads to the last but most devastating step, the crash. Inevitably, the stock price plummets, leaving other investors holding the bag. The entire setup is predatory by nature, capitalizing on human emotions such as greed and the fear of missing out. The Securities and Exchange Commission regularly uncovers schemes involving penny stocks. One of them recently being a $194 million pump and dump scam that led to charges against 16 defendants located across multiple countries. Yet, as shocking as these revelations are, why do people still fall for pump and dump schemes? Let's delve a little deeper into that psychological labyrinth. The low entry cost of penny stocks makes them uniquely popular. Almost anyone can buy a piece of this volatile pie. This opens the floodgates for the vulnerable, the financially desperate, the uninformed, and those swayed by the compelling stories spun around these stocks. Once invested, the dopamine hits hard. Each uptick in price is exhilarating, each downtick is gut-wrenching, but excused away as a temporary setback. In these emotionally charged waters, FOMO is the shark that never sleeps. Social proof amplifies the tempting call of that investment of a lifetime. You think to yourself, if so many people are buying, it must be good, right? This is an example of a cognitive bias known as herd mentality or the bandwagon effect. Herd mentality is the tendency to copy or follow the crowd at the expense of one's own independent research and ideas. Most people find comfort from holding positions that other investors also hold. No one wants to be the one who didn't get in when fortunes are being made. But too often, they are getting in just as the early manipulators are getting out, leaving a volatile stock plummeting back to earth and retirement dreams evaporating into the mist. Another cognitive bias that tends to be prominent in pump and dump schemes is the narrative fallacy. The narrative fallacy is the tendency of investors to be attracted to investments that have good stories, while overlooking investments considered to have rather boring stories. Though the seemingly boring investments tend to be much safer but won't offer anything close to the eye-popping returns promised with trading penny stocks. When one falls for a penny stocks pump and dump scam, it's not just the financial repercussions that are concerning. The high-stress environment that penny stocks create can lead to further poor decision-making, stress, mental health issues, and strained relationships, as oftentimes people are not forthcoming about their losses. If the penny stock market was a murky pond before, the internet and social media have turned it into a swamp teeming with scammers. With the proliferation of trading through apps and online platforms, virtually anyone can invest in penny stocks now. This has led to an influx of novice investors, many of whom lack the experience to spot a scam. Social media has proven to be an effective tool for the perpetrators. Twitter, now X, Reddit, and specialized trading forums are flooded with anonymous tips, recommendations, and inside information. In this chaotic sea of data, separating factual information from deceit becomes an impossible mission. Penny stocks are a scammer's paradise, as there is often a major lack of reliable information. Unlike companies listed on major stock exchanges, companies behind penny stocks are not held to the same reporting and transparency standards. This lack of information creates a breeding ground for false rumors and misleading press releases, tools that scammers frequently employ to deceive unwitting investors. While regulatory bodies like the SEC work to identify and penalize fraudulent activities, the sheer volume and complexity of the stock market make it a difficult pursuit. Moreover, the legal process is often slow, offering little consolation to those who have lost their investments. There's also a bit of a catch-22 situation. Excessive regulation could stifle the entrepreneurial spirit that makes the penny stock market a legitimate opportunity for small companies to raise capital. Too little oversight, however, leaves the door wide open for malicious activities. And given the glacial pace regulation tends to move, authorities often get caught a step behind the pump and dump schemers. Even though authorities like the SEC do crack down on fraudulent pump and dump scams, the scale and cover provided by the internet make it a game of whack-a-mole. Penny stocks will always hold a certain appeal. They offer normal, everyday people a chance to dream big, to turn the spare change in their pockets into a golden fortune. But like all dreams, it comes with a dose of reality. In this case, a dark, predatory side that exploits the naive and the hopeful. Investing in penny stocks isn't inherently bad, but it is inherently risky. To navigate these treacherous waters, one must be well-informed, skeptical, and be prepared for the worst. For every rags to riches story, there are countless tales of financial ruin, many birthed from the sinister creations of a pump and dump scheme. Would you gamble your future on a game you knew was rigged? Before you bet it all on that next hot tip, remember, when it comes to penny stocks, the house almost always wins. Thanks for watching, catch you in the next episode, and if you haven't already, subscribe to Deconstructed for video essays on money, wealth, and power.